Hi, this is Alan Gassman. I'm here with Christopher Denicolo, and we are really pleased to present to you something that we've been working on for many years, and that is explaining the installment sale to a defective grantor trust. This is a very good program for you to use to learn about this technique if you're not thoroughly familiar with it, to introduce it to your legal staff, and to, of course, share it with advisors and even clients. Somehow you could probably smudge our names off of the slides and off of the videos and just like put your name on there. That would be fine. I must say that for all the things we've done for wealthy clients over the years, by far the most effective and the most efficient and the most client-friendly arrangement has been the installment sale to the defective grantor trust. I met today with a client where we have moved significant wealth into one of these, and he said, well, what if I need to use it? Remember, your spouse is a beneficiary. Well, what if she doesn't love me anymore? Well, first of all, what makes you think she loves you now? But if she doesn't love you anymore, remember, we put it in Nevada, you might become a beneficiary if you become almost destitute or anything like that. Okay, well, thank you for moving 3/4 of my wealth to this trust. These are just great things. Now, I'm going to let Chris take over the presentation. He's much more likable than I am, for sure. And Chris, what do you have to say?
Well, first, it depends who you ask on the likability, but here, Alan, as you said, the installment sale to a grantor trust is very common. It's something that we've used quite frequently, and frankly, it's one of the more easy things to explain to a client. So today's presentation, we're going to keep it at a pretty simple level, really to illustrate the mechanics of how this technique works, what kind of approaches you can take, and really when it's prepared to be used, when it should be used. But before we go forward, I do want to make you aware of some upcoming PowerPoint presentations and webinars we have. Next Thursday at our Lunch and Learn series, Alan will be here to talk to us about the biggest mistakes physicians make as owners and non-owners in medical practices. And the week after that, John Beck of our office will be telling you how to not be passive with respect to your passive rental losses. And then again, the Thursday following that, we'll be planning for Florida dental practices and their owners. This is the second part. We do have a part one. If you've missed part one, let us know, and we'll send you in the right direction and get you set up with that as well. And here are, of course, the PowerPoints and webinars in the future setup. So when it comes down to explaining the installment sale to a grantor trust, we've found that we prepare a very simple, we call it a cartoon almost, but it's really a PowerPoint presentation to show clients how the technique works. And of course, our client, we'll name her Jane client and keep it pretty simple. Jane is age 75. Jane has significant wealth that she would like to pass on out of her estate for federal estate tax purposes. Now, the primary goal of using an installment sale to a grantor trust is to essentially take wealth in one's estate, which if they died would be hit with a 40% estate tax under current law, and then transfer that wealth outside of the estate so that when the client dies, the wealth or appreciation on such wealth is not hit with the estate tax. And that's really what we're going to focus on for the first 2/3 of our talk here today. There's a third wrinkle that we'll introduce as we get to it. So for Mrs. Client, we've essentially prepared for her a PowerPoint which illustrates the idea of, look, you have these assets. They're investment assets. If you place them into an LLC, and if you receive back voting ownership interest in the LLC, you can transfer the receive back voting and non-voting interest in the LLC. You can transfer the non-voting LLC interests to an irrevocable trust that you established for your children and other beneficiaries, including your spouse, and receive back a promissory note that will pay you interest and principal, if you'd like, over a certain number of years. And you're thinking, well, hold on a second. This is a sale. So we're trying to push wealth out, but we're pushing out a certain value of assets, and we're getting back a note with the same equivalent value. Well, this whole idea of the installment sale is that any growth on the assets sold which exceeds the interest rate are going to pass out of the estate. That is very important here. And now, in this current environment that we have, interest rates are very, very low. In fact, the average rate for a long-term note, which is a note over 9 years, under the IRS tables, is I believe around 2.5%, which is extremely low. And if you look at account statements for recent investments in the stock market over the past couple of years, you're well ahead of that 2.5% per year. So that difference, that threshold, they call it the over the hurdle rate, is what you're pushing out of the estate. So that difference is not going to be subject to estate tax. Okay? And this technique is a very good way of doing so. Now, a couple of comments on the trust. The trust, the irrevocable trust, which is sometimes referred to as a defective irrevocable trust or defective grantor trust. Let me be plain about this. There's nothing defective about it. All that it means is that the trust is considered as owned by the grantor for federal income tax purposes. And what that just says is that under the income tax law, the trust is considered to be the grantor. So any income of the trust or any losses of the trust go on the personal income tax return of the grantor. It also means that any transactions between the grantor on one hand and the trust on the other hand do not get recognized for federal income tax purposes, meaning that it's as if the right hand sold to the left hand. There is no recognition of gain. So unlike the normal installment sale, which involves the sale of assets to maybe a third party in exchange for a note, in that situation, you're going to have income tax when you receive promissory note payments. In this situation, because the trust is a grantor trust, then there is no income tax. And that's one of the huge benefits here, because not only is the transaction not considered to have occurred for income tax purposes, to not cause any income tax to occur on the sale, but also the grantor can pay the income tax associated with the trust after the trust is created, and those payments of tax are not considered to be a gift to the trust. This is an incredible wealth transfer mechanism that is used very commonly and that we think is very effective. So we skip ahead here to the next slide. I will show you essentially in a pictorial form how this works. And very simply, if we have Jane Client contribute investment assets to an LLC that she decides to call Client Holdings LLC and receive back 99% non-voting membership interest and a 1% voting interest, that transaction is not going to be an income tax event either. So by doing that, she puts these assets in an LLC. Now, we tell clients that you should wait to transfer assets first into the LLC before entering into the sale. And the reason for that is this. The IRS has really cracked down on something called valuation discounts. Valuation discounts, if I can explain them in 90 seconds or less, can be described as if you own a non-voting interest in an LLC or a minority share interest in an LLC, that minority share or non-voting interest is not worth the percentage of assets of the LLC. So, for example, if Mrs. Client puts $1 million of assets into the LLC, she takes back the 1% voting, 99% non-voting. If she transfers 10% of the non-voting just outright to her daughter, the transfer tax value of that 10% interest is not going to be $100,000. It's going to be something closer to $70,000, $75,000, $65,000. The reason for that is a willing buyer or a willing buyer of that interest would not pay $100,000 to basically own an LLC interest that doesn't entitle them to access the assets without the consent of the voting member, or doesn't entitle them to sell it on an established market like the New York Stock Exchange or NASDAQ or something. And the valuation discount mechanism by itself can be a great wealth transfer tool. And that is one of the components to what makes this transaction so successful. But if the LLC receives assets on day one and the sale happens on day two, the IRS will say, hold on a second. If you're trying to take that valuation discount, you just put these assets in here yesterday. There's no way you're going to get that 30% discount or so. So we like to tell clients, put assets in, give it enough time for the economic risk to be borne by the LLC, which in a lot of cases is 30 to 60 days. So you wait 30 to 60 days after transferring assets into the LLC before doing the sale transaction. Another component of the transaction is that this gifting trust, which is the Grantor trust that I've been referring to, should receive a seed capital gift, or should at least have a net worth of at least 10% of the value of the promissory note, or amount of the promissory note. And the reason is the IRS doesn't, the IRS would look at this and say, well, the promissory note's illusory if the trust doesn't have independent assets to pay it. So by making what's called a seed capital gift to the trust, usually in an amount equal to 10% of the sale price. So in our example, if Mrs. Client puts $1 million into the LLC and sells a 99% interest, and let's say, for argument's sake, that that's valued at $700,000 instead of $990,000, then the seed capital gift would need to be in the amount of $70,000. And that is a very important precursor to the transaction. And a lot of the transaction success relies upon the seed capital gift having been made properly and in the right time. So step two gets down to the meat and potatoes of the transaction, the actual sale. So we have Mrs. Client owning her 99% non-voting interest in addition to her 1% voting interest. And if Mrs. Client then sells the 99% interest to the gifting trust, now the gifting trust is your owner of the 99% interest, and Mrs. Client's going to receive back a promissory note equal in value to the 99% interest. We tell clients to get a bona fide fair market value appraisal from a reputable appraiser. That way, if the IRS ever questions this transaction, she can point to the appraisal and say, well, look, ABC Valuation Company came back and told me that this 99% non-voting interest is actually worth $700,000, and that's where I got this value from. It's very much a good idea to have that valuation report. Now, the promissory note here under step three that goes back from the gifting trust to Mrs. Client must bear interest. And as I mentioned, the interest rate must be equivalent to at least the IRS's promulgated rates, which are called applicable federal rates, and they're published monthly. In fact, the rates for February just came out several days ago, if not yesterday or the day before. And the rates are broken down really into three tiers. The first tier is for short-term promissory notes. And short-term notes are notes that mature in 3 years or less. The next tier is midterm rates, and those are for notes that mature in terms that are longer than 3 years, but not longer than 9. So anywhere from 3+ years to 9 years is your top. A 9-year note is in the midterm rate tier. And then finally, a long-term applicable federal rate, which is a promissory note that matures longer than 9 years. And which one to use, it really depends. For a long time, we were using midterm rates and using 9-year notes. The reason why we've kind of switched a little bit to long-term is because basically, I think many of you may have seen this, the short-term treasury rate has actually exceeded the long-term treasury rate. So, that means that the short-term rates, the applicable federal rates published by the IRS, are actually higher in some situations and can be actually relatively higher than the long-term rates. And we like to lock in this long-term rate. That way you can have a 20-year promissory note and have the low rate held for the duration of the loan. So if we get interest rates that start to climb back up to 5%, 6% or more, if you lock in an interest rate of 2.5% per year, then you really are doing a great job, especially if your investments are earning maybe a higher rate of return based upon the higher market rates available at the time. Now, the promissory note need not be interest only, but we like to use it that way because, as more payments go from the client's gifting trust or the grantor trust back over to the client's living trust, that introduces more wealth into the client's estate. So the more deferral on that stream from the gifting trust over to the living trust, the better off the transaction will be from an economic standpoint. Nevertheless, many clients come to us and say, well, hold on a second, I want to get more than this back. I want to get payments back equal to the dividends that I was taking. Okay, well, we can structure this transaction so that you'll receive payments that include some principal. And by doing that, you're essentially reducing the amount that has to be paid back ultimately. Although you're kind of reducing the optimization and the full benefits you can get from this transaction. Like I said, we usually go with a 9-year or even longer interest-only note. There would be a balloon payment of principal at maturity, which means that upon maturity, the gifting trust would have to pay all principal then outstanding owed to the living trust. But a pretty easy mechanism to understand and explain to clients. Now, during the term, as I said, in this case, we did a 9-year note just to illustrate the concept. Interest or whatever the payments are must be made timely. Additionally, the ownership of client holdings here the distributions must be paid consistent with the ownership. So income of 99% passes out to the gifting trust and 1% passes out to Mrs. Client. The reason why we do this is we want the transaction to be respected. We want client holdings to be respected as an independent entity. Now, that is very important for this type of transaction and really the integrity of any structure that anytime you use an LLC or corporate structure in an estate plan. So at the end of the day, when the note is paid off, we have the gifting trust owning 99% ownership in the company. We have Mrs. Client owning 1% of the company, as well as the promissory note payments that she has received throughout the note term. But this is where we want to be at the end of the day, with the benefits being that the assets in the client gifting trust are outside of Mrs. Client's estate. They will not be subject to estate tax on her death, and the assets in her estate did not get hit with a gift tax, nor did they reduce her estate tax exclusion amount that she would otherwise have upon her death. So this is a really effective way to transfer assets out of one's estate without using any gift tax exemption or incurring any gift tax costs. Pretty straightforward so far. Now, part 2 of the presentation is the same structure with one very important wrinkle. This wrinkle is having the promissory note be a self-canceling installment note as opposed to a conventional note. A self-canceling installment note does exactly what it says. What this means is that upon Mrs. Client's death, if she dies during the term of the promissory note, whatever is owed under the promissory note goes away. It's no longer owed by the gifting trust to Mrs. Client. In fact, the gifting trust will now continue to own the assets that were sold to it as part of the transaction, and Mrs. Client's living trust is not entitled to receive any payments under the note. A couple of issues with this technique. Number one, the interest rate that must be charged on this transaction has to be a heck of a lot higher than the 2.5% that we used in the conventional transaction. Okay, this interest rate is really determined by a factor of, first, the baseline interest rate that we would use, plus something called a risk premium. And that risk premium accounts for the fact that, look, Mrs. Client might not survive the duration of the term of the note. And if she doesn't, the note goes away. So in exchange for that risk, we're going to command a higher interest rate. Commercial actuarial software such as Tiger Tables or Number Cruncher can calculate this for you. My first year as an associate, I tried to do it by hand. And let's just say there's a reason why these commercial software programs do so well. You plug the numbers in, you push a button, and it spits out. It really depends upon the client's life expectancy relative to the term of the loan. That brings us to another issue. The promissory note and the interest rate really must reflect the actual life expectancy of the client. There was a case a couple of years ago called the Davidson Case, where the IRS really looked at the idea of doing this self-canceling installment note transaction, or a SKIN, as it's called, transaction, for a client who has a severely diminished life expectancy. And that, look, the actuarial tables do not accurately reflect this client's life expectancy. So by using your garden variety risk premium, that's not indicative of what the likelihood of the seller's life expectancy would be. And with that, the safer way to do this is to assure, at least get information in your file from a doctor confirming that the grantor has at least a 50% chance of surviving to his or her actuarial life expectancy, which in many cases is going to be met because the actuarial tables actually are 10 years old and involve, a number of factors such as, infant mortality and premature deaths for accident and things like that, that drag down the life expectancy tables, whereas a wealthier individual with access to health care and the best forms of health care might have a real life expectancy that's longer than the tables. But that's a hurdle that should be surmounted, I believe, and we think that it's one of the key components to making sure that the technique will be successful. Now, another consideration is if the client survives the note term, then it might backfire. Because the interest rate is so much higher in a lot of cases, especially with an older client, then you're not going to have the benefit of, look, if the client survives the note term, additional interest or additional assets will come back in the client's estate for federal estate tax purposes, which can really backfire. And certainly we don't want our clients to die prematurely, but this technique needs to be considered really for those clients who are not going to live well beyond their actual life expectancy. But when they are really helpful is if you have a young client who's maybe in their 30s, 40s, or even lower 50s, because they're so young and their life expectancies are so long at those ages, the risk premium is not really that high, so the interest rate need not be that high. So if you have a 45 or 47-year-old client doing this type of transaction, maybe you add a risk premium and make it a self-canceling installment note, because the client's life expectancy might be 35 to 40 years, and if the risk premium is only an additional percentage or 2 point on the interest rate, then you're buying yourself that feature that the client does unfortunately die before his or her actual life expectancy. Then you're able to take advantage of this ability to essentially eliminate the value of the promissory note in the client's estate. So going through the pictures that we ran before, similar concept, Mrs. Client funds the LLC. Okay, she contributes the seed capital gift to the gifting trust to help assure that the transaction will be respected. Okay, then the client sells the interest in client holdings, the 99% non-voting interest, to the gifting trust. So now you have the gifting trust as the 99% owner. Mrs. Client's living trust is a 1% voting owner. And just like before, you have the promissory note issued. The difference here is that the payments are a little bit higher, and the length of the note really shouldn't be more than the client's life expectancy. Okay, I do want to point out with the self-canceling installment note, we really need to make sure that you have the doctor notes in a file. You also want to make sure the interest rates are made timely, as with the conventional note. But with this self-canceling installment note, it can hit home runs for clients because the note that is owed back here, as I said, from the gifting trust to the client goes away if the client dies. So going to this slide on number 23, if the client dies, the note cancels upon Mrs. Client's death. No further payments are made. Okay, you've essentially eliminated the value of the promissory note from Mrs. Client's gross estate should she die during the term of the note. Under the conventional scenario, if Mrs. Client died during the term of the note, then whatever's left on the promissory note, the present value of that note would be included in her estate for federal estate tax purposes. Nevertheless, the appreciation on the sale would get out of her estate, but with the self-canceling installment note, you would get the benefit of the amount of assets that were essentially left unpaid because the note canceled, no longer being included in her estate. And that is a really important wrinkle. It's worked well for a lot of clients. We have taken this planning technique to another level with something called the SCRAT. That's beyond the scope of today's talk, but I think that we have PowerPoints on it that we've done before, and maybe I'll talk with Alan about doing the SCRAT presentation again, because it certainly is relevant in today's interest rate environment. So moving on to our third idea with respect to installment sale transactions. What I've talked about thus far doesn't really give us an income tax benefit. It's purely for an estate tax benefit. And for a lot of our clients, estate taxes are no longer an issue because now we have $11,580,000 per person as an estate tax exemption. And if they're married, that number doubles to over $23 million. Now, those amounts are supposed to drop roughly in half in 2026, assuming Congress doesn't change it again. But in any event, a lot of clients aren't going to worry about the estate tax. They have no concerns because of these elevated exemption amounts. However, they always have income tax planning concerns. And the installment sale can be a very important tool for clients to achieve income tax benefits. One benefit provided by the current tax law is that if an individual dies owning assets in his or her estate, well, the heirs of those assets, in most cases, and there are some exceptions, are going to get a step up in income tax basis upon the ancestor's death. And what this means is that if I have stock that I bought at $10 a share, and here I am on my deathbed, it's worth $100 a share, and I die. Stock's worth $100 a share, I bought it at $10 a share. Okay, there's $90 of accumulated appreciation. If I leave that asset to my spouse or to any other beneficiary for that matter, then the basis on after my death will increase from $10 a share to $100 a share, which means that if my spouse sells the stock on the next day after my death for $100 a share, she pays no income tax. So one way we're planning now is we're turning this on its head by intentionally causing assets to be included in someone's estate to get the benefit of that step up in basis. This is a great tool. And people say, well, great, why can't I just give everything that I have that's appreciated to my grandfather who's, got terminal cancer, and then he'll just give it right back to me? Well, the IRS thought about that, or rather Congress thought about that, and there's an exception to that step up in basis rule that says if you gave someone an asset and they give it back to you within a year, then that step up in basis doesn't apply. So you can't really do that. But it only says that the exception applies if you give the asset to someone. So the way that we have done this is have the installment sale transaction, sell to a grantor trust where you don't have an income tax event on the sale, but say give your grandfather a general power of appointment under the trust, which is a fancy word for it. You give your grandfather the ability to appoint assets held under the trust to the creditors of his estate if approved by your CPA or some other independent party. If he has that general power of appointment, then the assets in the trust are included in your grandfather's estate. And if he doesn't have any estate tax situation, there's no estate tax generated, and then the assets can pass in a trust for your beneficiaries or your family, or even to you in certain situations, with a fresh basis, so that now you will get the benefit of a step up in income tax basis, while not necessarily getting any estate tax benefits, because estate tax is not a concern. But with the installment sale technique, you can utilize your grandfather's estate tax exclusion amount to essentially refresh the basis of your appreciated assets. This is a really neat technique that's really come about since the exemption levels have gone up to where they are, and certainly one that should not be forgotten by a lot of planners.
Chris, what if there's depreciated property and there would be depreciation recapture?
Well, depreciation is not available for the increase in basis is not available for depreciated assets if the only reason that the inclusion occurs is because of the general power of appointment.
So I think you lose the step up to the extent of depreciation that would be recaptured.
Now, another way to
get the step up of anything above that.
Right. That exactly. That would be one consideration as part of this. And of course, the step up in basis rules don't apply to IRAs or other retirement plan or annuity assets that have something called income in respect of decedent.
Does Grandpa have to know that he has this power?
I don't think he does. And the safeguard there of having it exercisable only with the consent of independent parties, that he doesn't recklessly exercise the power, can really make it so that you just kind of give it to him on paper and get this new basis. Certainly there's the risk that the IRS can say it's all illusory, but we haven't seen any challenges on that basis.
Yeah, great point. So should we go to slide 26?
Yeah, and I think that gets us towards the end here. I know that we're butting up against the time. What I've just said about this technique here on slides 26 and 27 is described in more detail. I did want to just at least illustrate these concepts verbally, but it is important that if you do rely on this step up in basis by transferring assets to an older family member, that it be done via sale and not gift because of that 1-year exception rule that I mentioned. So a really neat little technique you can put in your bag of tricks and explain to clients who might get a great benefit out of it.
The beach is not very crowded today. For those of you who don't mind 50-degree weather, you could jump right in the water, right?
Yeah.
It looks really nice. Okay. Well, we thank everybody for participating here. Don't forget, January 30, I'm going to talk about the biggest mistakes physicians make as owners and non-owners in medical practices. And John Beck is going to talk on February 6th about don't be passive rental losses. I'm going to do part 2 of planning for Florida dental practices and their owners on February 13. We've got other programs coming up. We are going to announce new programs in the near future. Let us know if there's anything you'd like or that you'd like to see. Thanks again, Chris. That was a great presentation. And may the rest of everybody's day be billable.